Well, thank you everybody for being here today. And what I want to get into today on this Saturday event is I want to kind of cover and go over 7 different option kind of strategies that really kind of take advantage of time and volatility, time decay and volatility kind of crush for, for income, for hedging, and then also, for buying options at a discount. And one of my, big favorites is the counter diagonal. So that's kind of what we're going to dive into today. So again, thanks everybody for being here. And, that's what we're going to kind of cover. But first, a little background on myself. I've been actively trading now. I kind of pinch myself for over 40 years. I started my trading journey back in the 80s with a company called Coastal Corporation out of Houston, and was fortunate to get my foot in the big door of that company, and got accepted into. They had a training program where they would actually train you to, trade crude oil and oil products and things like that. So at that time, it was a really hot industry, still is, but that was the big place. All the different oil trading. So it's very exciting. It started out, they sent me down to their, one of their refineries for, about a month and a half, and that was great kind of learning experience because you got to see the foundation of oil, how you would bring it in on tankers, put it through the processing units, produce gasoline, fuel oil, all that kind of stuff, and so it kind of got you really grounded as to how the industry worked. So eventually ended up in the shipping department, with the tanker chartering and scheduling ships, and that was really cool. Loved that a lot. And then ended up on the cargo side. So Coastal was really known for all of its really great traders that came out of Coastal that went on to other different companies. Ended up going to Singapore with Coastal for a couple of years. And great experience out there, traded products and Asian crudes, and then got a job with a company called Transworld Oil, which at the time was the largest oil trading company in the world. Transworld, along with Fibro and Mark Rich, and that was super exciting. So that was back in the mid 80s, and spent about 16, 17 years there, and spent about a little over 15 years in their corporate office in Bermuda. And ended up running the international trading desk out of Bermuda for 10 years. So that's where really started trading options back in 1987. I remember the Wall Street guys would come down. At that time there was no clue as to you kind of knew what options were, but you had no idea how they worked. So they would come down and do their dog and pony show and teach you kind of the basics of the options, and it was just kind of learn on the fly. So that was the start to the option side of things, and kind of never looked back. So really enjoyed it, and we're going to dive into some really cool option strategies today. And one of my favorites here that I like to use a lot, the counter diagonal. So again, thanks for everybody being here, and let's get started. So the following presentation today is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. So, when you're looking at different income selling type strategies, what they do, that they enable you to enhance your returns by the way of combining long options with short options, so they can generate income on a regular basis. So this is kind of my favorite. I like to mix, and I call it mixing and matching. I like to take long options, which give you that extra potential profit potential, and then mix those with short options that bring in more time decay and implied volatility that you can take advantage of to lower your cost, plus increase your, given your positive beta, things like that. So it's these kind of income option strategies that are typically more short duration, whereby the option premium you're selling is either maybe on a weekly or monthly basis, so you can kind of collect that premium or income. So this can really help you to generate significant kind of percentage returns over, your underlying security or stocks. And it's really kind of like collecting rent on a security. So if you've got any rental property or had some, you know what that's like. You own the asset, you collect that rent every month, and over time it amortizes down the cost of your property to give yourself a bigger return on that capital, and that capital that you're starting to amortize down. So you can do the same exact thing with your stock securities. So which makes it a really great great thing to apply to your trading or to your investing. So kind of step one is to understand, how option pricing works and selling time, how that's the big kind of pricing component that really makes these kind of strategies work. So when we're, trading options and option strategies designed for income, the most important option factor comes down to understanding that concept of time and the impact that it has on your price of your option or the value. So we can, actually trade time by selling time to take advantage of that time decay component of your option. Now, when we look at the, pricing components, time is one of the major ones in implied volatility. But when we look at time decay, it's basically your extrinsic value of your option. So it's the, it's the premium that the trader or the investor is going to be willing to pay over the current exercise value, that intrinsic value, based on your option's potential to increase in value before it expires. Now, it's this change in the value of your option based on the time decay. We can measure that using the Greek called theta. All right, so then time decay basically it's going to increase as expiration draws near. It really starts to accelerate. And then it also is going to decrease as options go more in the money or out of the money where you have less extrinsic value. Now, the option theta really soars when you get to the last kind of final 30 days of your option cycle. That's where it really accelerates. And at the end of the day, at the end of that cycle, it goes to zero. So when we look at this kind of chart, you can kind of visually see, now when we start out, 120 to 90 days out, the time decay component is very, very small. It's very, very gradual. But as you get closer, say 30 days out, that's where it really starts to accelerate. And the great thing now is that we've got, weekly options, even we have same day options, so we can really do some really creative, really cool stuff, taking advantage of the option theta decay and cheaper options as they get closer to expiration. So we can use weekly options, we can use daily options, we can do a lot of different things to bring in income, decrease the cost of the trade, give us, more positive data. So many different things we can do with the different option structures and different strategies that are out there to use if you just know how to use them. So that's kind of basically where you start off, understanding how that time component can be, put in your favor. Now, two is then, understanding how option pricing actually works. And again, when we look to the value of an option, it comes down to that time value component times the implied volatility times the underlying security value, the intrinsic value. Now, once we know these variables, then we can plug these things into our option model, and we can get a theoretical value of what the option would be, priced at over time at certain periods of time. And we can see the price, we can see option theta, we can see all kinds of different things on our option model. So really interesting, way to, theoretically see where price can go and just, values of options and things like that. Now, here's a really good example of how the flow through works for value in an option. So again, if we look at the value of the option, major key components will be the time value component times the implied volatility of your underlying security times the underlying value, the intrinsic value. So that's going to give you the premium or the value of your option. Now, in this example, I'm going to keep the intrinsic value constant at 1, so you can just see how time and volatility flow through to create the value or price of your option. So, when we come in after a weekend, or let's say on a Thursday, every Thursday we have a new weekly option series, okay? And on that first day, we've got 100% time. Now, just kind of plugged in a number here, so implied volatility of 300. So if we take that 1 times 300, leaving this constant, you can see the value of the option would be in this example, $300. Now, you come back in, after the weekend, and you're still getting that time K even over weekend. You can see that in Monday you come in, that time component is cut in half. So even if you had your value of your applied volatility spiked up to 800, you can see it barely pushed up the value of the option in this example to 400. So, if you did have implied volatility, say like 200, then you can see the value of the option would be only $100. So the main takeaway here is to understand that this time value is starting to decay each and every day, and at the end of this cycle, it goes to zero. All right, so it's a big fat zero. Also, implied volatility goes to zero. So this is a selling side component from options that we can take advantage of by selling time, selling volatility, we can take advantage of that, time decay and implied volatility crush, which really has a huge impact on the value of your options. So we can take advantage of this with straight selling type strategies, or mixing these kind of components with long side options as well. So that gives you a good kind of reference point of how time and implied volatility can be, enhance your trades. So the next thing, really important part of trading, and especially option trading, is understanding the probabilities. So trading the probabilities is what, kind of what I call the market maker secret. It's what they don't want you to know. And so it's how they value the option and how they trade, which is kind of the professional money. And again, it's going to be based on, implied volatility and kind of standard deviation valuations of theoretical price where options should be. Now, when we look at the option markets, the option market makers use mathematical market probability statistics for pricing the movement of an option to its expiration, using the option models, which is basically based off the Black-Scholes model. So by knowing the probability of your underlying security finishing then within a certain price range at expiration, it becomes really key to then determining what options you're going to either buy or sell, and then what option strategy to use. So it's this forecast is what we refer to as the implied move of your stock, or the implied expected move, you might hear it called that. Now, all it really is it's the implied move is basically an estimation, a theoretical estimation of about one standard deviation up or down of the move of your underlying security by its expiration. All right, so I always like to explain one standard deviation when we're trading options as kind of a normalized price movement, either up or down. Now, once you get past that one standard deviation, then you're starting to get stretched and extreme, and more, lesser probability of those price points being hit. So if we were to look to, in this example, if we were to sell an out of the money option, one standard deviation out, you're going to theoretically start out with an 84% winning theoretical chance of winning. All right, so that's based on your option delta. So when we look at option deltas are either a plus or minus 1, and what that represents is, remember, one option contract is equivalent to 100 shares. So a delta of 1 would be like 100. So it'd be like you're owning 100 shares. So if you were to sell, like in this example, this outside point here, the 520 strike, and it had the option delta of like this 16 or 20, that is starting out this trade with a 84% probability theoretically of winning. So you take that 16 delta short strike right here, which would be the 520. All right, so that's roughly a 16 delta in this example, and that's going to give you the reciprocal of 84. So you can look at this then is if you were to sell that 520 short strike with that one standard deviation outside point, you've got a 84% probability that price will be below 520 at expiration. Or if you were to sell the 480 put with a minus 16 delta, you've got a 84% probability price will be below 580. So that's a really important part of your trading to start out with. So kind of looking for that normalized move, either one standard deviation up or down, and that's going to help you then determine, what strategies to use, what targets to use, et cetera. So you can see that this one standard deviation up here is like plus 4% up would be 520, 4% down 480, and that's your kind of one standard deviation price range there. So that's how you can really help to start your trade out. So you can see here's a normalized move. Then when you start going further out the curve, there's less probability to make for price to get to those price points. Okay, so you're really tailing off here. So that'd be like 2 standard deviations out. All right, so that's a key, really helpful kind of graphic to see how probabilities kind of look and how you can use those to kind of enhance your trades by selling options. Now, so then when we look at the option delta, here's a good example. And this is Apple. So you can see here I've got delta, and this is probability out of the money. So if we look at this example, Apple trading at $190, if you look at the at the money price, so the 190 strike, you're going to see the delta here says 0.52. So that's basically a 50-50 chance. So if you were to buy that 190 strike, you've got a 50% probability that price will be at 190 or below, or 50% chance at 190 or above. And you're going to see that if you go further out of the money, so let's say here to the 215 strike, you can see here it has a delta of 5, right? All right, so if you look there and then you look here, probability out of the money, you can see that it is telling you 95. So there's basically that 100 delta. And then if you were to sell that 5 delta there, you've got your probability out of the money is 95% of the time. Theoretically, price should be below 215 at expiration. Or the other way I like to use it is, okay, let's say if you're looking to buy that 215 or sell that 215, you could say there's only a 5% probability that price will be at 215. All right, so it's a really good, quick way to evaluate probabilities of certain price points, various strike points of your options being hit, and then you can utilize this to make quick decisions as to, you know, should you sell that strike, should you buy that strike, what should you do with that specific strike based on the option delta and the probabilities that it gives you, that kind of information. So it's a really quick reference point for your trading. So it's something we are always constantly talking about, or your, you know, option deltas. Now, then by understanding this probability analysis, this really then, you know, helps you and provides traders and investors a very useful tool then to determine price targets to trade against, you know, and it's going to be free on most option platforms. So I like to use Thinkorswim, and, you know, it's going to give you that information right there, you know, on the side of the platform. So I'll just pull it up real quick here. You'll see. So if I was to take, let's say I just happen to have Exxon Mobil up here. If I pull up the option chains, you can see this option delta expected move kind of is given to you right here with Thinkorswim, right over here in this right-hand corner, right here. So you can see it says plus or minus, if you can see that, minus $2.97. So that's the implied expected move up or down. So that's for this next week series, the 23 May, 6 days out. If you go down here, let's say to the 18 July, 62 days out, you can see that the expected implied move is about $9 up or down. So this is a really quick reference point to, you know, theoretical probability. So if you just put this to like a bell curve to kind of get an idea, if we're looking at this option series here, and Exxon is trading at, let's say, at the top of the curve right here at 108 at the money for the next 6 days, the theoretical move up, the market, I'll just round this up, I typically do that, would be that it could go up $3, okay, or it could go down $3. Okay, so that would be one standard deviation or expected move, one standard deviation up, down, your implied expected move range, okay? So that would be a normal range right there now. And then as you go further out, you know, you can see there's a less probability to hit that point. Now, as you go further out, you can see that range increases. So if you go way out here, you can see it's plus or minus 19. But anyway, that's where we start with the trade, and we can then kind of get an idea theoretically, you know, what price should be. All right, so that's a really valuable information. And so that's given to you there. That's also based on what we call the straddle cost. So based on this math of probability, you'll see that approximately over time, you're going to see that approximately 70% of all options that are bought are going to expire worthless. And so based on this, it's a really good idea for traders and investors to consider selling options as well as just buying them. So buying that, you know, by adding that option income selling strategy to your portfolio, it's going to make a really dramatic difference over time. And it's going to, you know, really help your trading performance when you use these this data and this information correctly. So again, remember, trading is a business of probabilities, and to be successful really comes down to controlling your risk and then incorporating high winning probability type option strategies in order to win the race. So it's a long-term, you know, race when we're trading. We're not into it, you know, if you want to stay around for the long term, you've got to understand these kind of basic fundamentals and really look at the probabilities, not looking just to hit that home run. I always talk about, let's just hit singles and doubles, and then occasionally you're going to hit the big triple or home run. So that's kind of the way I look at trading. So I always look at the risk first, control that risk, and then let's see what comes to us from there. So the step 4 then is selecting the right, you know, option strategy or income strategy. And in my opinion, one major goal for every trader should be to select trades that's going to, be based on what's going to provide you the most consistent positive returns over time with low defined risk, and not always that, big home run greatest return. And, one of the best ways to achieve this is to know, the different option strategies that are available, how they work, and then select the one that's going to be best suited for your trading style and the market environment you're trading. So that's kind of what I wanted to do today, kind of show you seven different kind of strategies, and then you can kind of get an idea which one may match your kind of risk parameters, your profile, and your capital account, might match up best for you. So what we're going to cover here today, we're going to go over the covered call, which is a really good basic strategy, but it's still a very, very great strategy to use. Then we're going to cover also what we call the protective collar, okay, a really great hedging type strategy. We're going to go through the vertical credit spread, a really great way to collect income. We're going to go through what we call the iron condor, the butterfly, and then two that I really like to use that are kind of really go-to for the trading portfolio is the income calendar, and the one that I really like a lot, the counter diagonal. So that's what we're going to go through. So it give you an idea of these kind of strategies and see how they kind of work, and then what might relate best to you and your style. So number one, let's talk about the covered call. Now the covered call is kind of more of a longer term growth and income strategy. It used a lot by investors, and also institutions are really getting into a lot of covered call type strategies with ETFs. Now the most basic then strategy, but it's highly effective, is to bring in weekly or monthly income, is for a covered call. So for example, and this what we're going to go through is Joe, he owns, let's say, 500 shares of XYZ, and he bought these shares for $40. Now he's tired of earning like a 2.5% annual dividend, which he's happy to get, but it's not very much income when you look at it, over an annualized period. So he wants to earn more than that, and so he's heard about selling calls against his underlying security that he owns. So this is basically what Joe does. So this is a basic covered call. So let's say on the 16th of May, Joe goes out and he sells 5 of the 27 June weekly calls with a $42.50 strike, and he gets $1 for each that he sells. Now remember, he's long the shares at $40, so he's going to sell the 42.5 strike, which would be above the $40 shares that he owns. So he's going to sell those, and he's going to bring in $1. So he's got the shares, I'll just put that down, that he owns here at 40, okay? And then he sells the strike above it, the 42.5 right here, and he's bringing in $1. So that's what we basically call a covered call. So he's going to get, in this example, selling 5 option contracts for $1, he's going to bring in 500 bucks. All right, so that goes straight to his account. Then he, pockets that, and it's put in his account, and until expiration, we'll see where it goes. Now, if he receives and keeps that at expiration, he's going to get that about 2.5% return in a little over 6 weeks. So he's going to get that on top of what he's going to get, with his annual dividend. All right, so he gets that and he keeps that too. So this is a really great way for Joe to collect some additional rent on those securities that he owns at $40. So here's basically what it means. So basically what has happened is that Joe is given the right to the buyer of those call options, the right to buy that stock, or those options, to buy the stock, basically exercise it at any time up until the Friday, June 27th, which is the 3rd Friday of the month, or before, at $42.50. So American options, you can come in and exercise at any time. All right, so if whoever Joe sold those options to wanted to, they could automatically exercise them. But here's basically what happens at expiration on Friday. Now, on the expiration day on Friday, though, the stock wasn't at 42.5, it was just at 42 bucks. So the options that Joe had sold at 42.5, they expired completely worthless, and Joe was able to keep that $100 or $1 per strike price of 42.5. So he ended up making $500 by selling those call options. So he's really excited about that. All right, so that's a perfect scenario. Now, what if the stock had gone to 43? Well, Joe could have bought back the the options the day of expiration, you might have lost a little money, or you may have made some because maybe with the time decay component, they may have gone down in value. Maybe so from $1 now, maybe they were just 50 cents. So if that was the case, you could have bought them back for 50. You would have ended up making $50. $1 less the buying back at 50. So you would, now if it drops in value, if you were to own a put against it, you would be protecting gains against any downside move. So this is what's known as a protective collar strategy. So what it basically does is going to combine it's combining the protective put along with your covered call. So it's got the protective put, or sometimes referred to as the married put. And what that does, it involves being long a put option and long the stock, okay? Now the covered call is your long the stock and short the call. Now when you marry the two together, then you've got what we call the protective collar option strategy. All right, so it's a really great strategy for protecting downside risk. And we can typically finance that by the put strategy, or sometimes what we can do against it is, do other things to finance that cost. But that's the basic put kind of collar. Okay, so let's go through what old Joe does. So if the stock goes down, and your call value option would go down in price as well, right? So think how this would flow through. So if your stock goes down and you're short a call against it, okay, the short call will go down, allowing you to buy back that call at a cheaper price if you want. So giving you profit on the call option that you sold. So most likely that short call option then is going to expire, worthless, and you keep that premium. So remember those, you sold that call option at a higher price. All right. Now, if you had the value of the put option is going to go up. Now, how do you use options to go short? You either sell a call or you buy a put, right? So if the underlying security or stock you own goes down, and if you're long a put, that's going to go up in value. So that's a way that you can buy puts. That's a way to short the market, or sell calls. That's a way to short the market. So if the stock goes down, your call option you short it goes down in value, so you cover that back for a profit. And if you long the put against it, the put option that you bought is going to go up in value, so you have that increase. And that's going to offset then the underlying value of your stock that goes down. So the stock goes down in value, a lot of that's going to be offset by the profit from the long put and the profit from the short call. And that's what we call the protective put, or the collar. All right, so here's what happens to old Joe. So in this situation, Joe, he still owns those 500 shares that he bought at 40 bucks. Now, on the 23rd of May, though, he decides that he's going to, see the stock now is trading at $45 per share. So Joe, he wants to temporarily hedge that position due to that increase in the overall market uncertainty and volatility. So what he's going to do, he's going to go out, he's going to buy 5 of the June 27 weekly put options on those shares that he owns at 40 bucks. And so remember that, one contract's equivalent to 100 shares. So the strike price that he's going to buy is the 39 put, and he's going to pay 90 cents per option contract. Now, at the same time, though, he's going to sell 5 of the 27 June weekly calls at the 49 strike, and he's going to bring in $1.10. So he's actually financing the cost of buying those puts, so he's going to be bringing in $1.10. His cost there is 90. So he's financing that put hedge value there. So here's what happens, and let's go through the cost of this collar. So basically what's happened is he's got the 500 shares long at 40 bucks. Now he goes out, he buys the 39 puts, he pays 90 cents per contract, and at the same time though, he's selling the 49 call against it, bringing in $1.10. So net, he's actually got the collar cost on for net credit of 20 cents per share. All right, so now his break even has gone from 40 less that 20 per share. So now he's lowered his break even to $39.80. So his max profit then is going to be capped at 49. So at 49 or above, he's going to basically be making this. He's got the 5 contracts, and remember, one contract's equivalent to 100 shares. So then the the hedge, he sold at 49 plus the 20 cents he gets, less the $40 the cost of his shares. So, go through the math there. Joe would make, if it's at 49 or higher at expiration, he'd make $4,600, or he's going to make a 23% return on his 500 shares at 40 bucks. Now, but he's also capped the downside risk. So he's got that 39 put, and he's got 5 contracts of those. So he's got the $40 there, his value of the shares he owns, minus the 39, the put that he bought, and plus the credit. So in this situation, the market goes down, he's capping his risk at 39, and he would only lose $400, which would be a 2% loss versus a much huger loss. So that's the beauty of using this protective collars type strategy. And so we can do this on stocks, or we can do it on full portfolios. So it's a really great strategy to learn and understand. Now the next kind of really big one that's really popular is your credit spread. So the credit spreads, again, is kind of what you call the probability trades, basically. And there are 3 kind of variations of credit spreads. You've got the bear call credit spread, the bull put credit spread, and then you've got what we call the long iron condor, which is the combination of basically the bear call credit spread and your bull put credit spread. So these are real popular for just bringing in income. So if you're using the bear call credit spread, it's going to be best used if you're looking at the market. It's going to probably, your bias is potentially that it's going to go down, but it doesn't have to. So the market could just go sideways, and you're still going to make money over time from the time decay. So basically what you're doing is you're going to be selling one call out of the money, while at the same time buying another call with a higher strike. Also, these are in the same option series. All right, so that's basically the setup when you're looking at a bear call credit spread. So you're looking for your overall direction. You think it's going to go down, but it doesn't have to. It can just turn sideways, and you still can keep the revenue or the income. Now, these are what we also call a negative risk ratio type trade. So, for example, in a credit spread, you're going to be risking more than you can make because, again, these are what we call probability trades. So in this example, you can see here, if you sold that 1020 strike short, you have a short call there at 1020, and you bought the 1030 to cap that potential risk. If it keeps going straight up, you don't want to be naked that call. You could be naked, but if it goes up, you have unlimited risk. So you buy that call there. So that's a $10 wide spread. You can see $10. So this would be roughly like a $1,000 wide spread. Now, you sold the 1020 strike, and for doing that, you brought in $200 credit right there. So that goes into your account. And then the difference, though, you've got the $200 credit. The difference is $800 would be the potential loss, and that's your margin that you would have to put up. So if you did one contract, you'd have to put $800 up in margin in case the trade did become a loser, and you would lose $800 bucks. So the brokers require that. Now, if it closes below that short strike of 1020, then you keep the $200 bucks. And if you look at the return, that'd be a 25% return. All right. So again, if you break that down, you're risking 800 to make 200. So you're basically risking $4 to make $1. So that's what we call a negative risk ratio. All right. So, and typically, you can see here, this was selling like the 20 delta short strike on that 1020 call. So that gives your trade going in about an 80% probability, looking at delta. Okay. So that's your typical kind of setup there. Now, here's an example of a bear call credit spread, on a Tesla. This is based on what we call cycle reversal. So these are really good sometimes. They're very selective when I use them, but I like to use them when we're starting to see a major reversal. So right here, you're seeing the price had moved up on Tesla, and then it's starting to stall out here, and we're getting a reversal that potentially could build into something bigger to the downside. So when typically we get a reversal from a very kind of overbought condition, this is a great place to set up the first kind of trade. Would be an out of the money bear call credit spread. So that's where I really like to set these up. So this was an example of one that we had on Tesla when we had that cycle reversal. So that's what the chart was looking like. And so then the trade setup was currently doing this. So it was the call credit spread was set up on the 18th, and it was trading at 265. And so shorted the 282.5, 285 with the short strike here at 282.5. All right, at that time when that was sold, that was a 23 delta on that short strike of 282.5. So then, the theoretical probability then going into this trade was that short strike, and take that delta of 100 in your delta there of 23, you had a probability theoretically of a 77% winning theoretical probability that price would be below 282.5 at expiration on the 29th of September. So then if that was the case, then the trade would, would keep that premium, and you would make, in this example, you would make about a 25% return. Now, this trade ended up actually making that because it closed down here. So it made the 50 bucks, which was the premium received, and that was a 25% return over that 8-day period. So that's pretty typical of the kind of returns on a credit spread, anywhere from 25, depending on, how close in or how far out you sell the short strike, depending on that, it's what's going to dictate the profit and the return on capital. Now, this one was going out further out to give yourself a higher probability. Now, if you came in closer, you're going to get more premium, but then the probability of the trade being successful theoretically goes down as well. So you kind of have to, offset the two of those and see which one you prefer to have. I typically like to look at the higher probability side of things on these types of trades. So that's kind of a quick overview there of the bear call credit spread. Now, the opposite of that is what we call the bull put credit spread. So this is going to be best used when you think the market's going to go up, all right? So if you sell a put, you're basically going long. If you buy a call, you're going long. So this would be taking advantage of an up, move in the market. So, but you could still make money over time, even if the stock was to stay stagnant. So this would be selling a put, out of the money, while at the same time buying another put with a lower strike, also in the same option series. So here's, again, is a negative risk ratio. So in this example, this was like on Apple, and here you were selling the short the March 149 put here, and then buying below it to cap the downside risk. If it kept going down, you were going to buy the 44 put here, okay? So you had this short put here, the 149 right there, and then you had this one long. So this was a $5 wide spread width then was $5 wide, okay? So $5 wide, and then you brought in a premium here of 105, okay? So that would be your profit if it closed below your short strike here of 149 at expiration, and then your profit, your potential, margin would be the difference of 395. That's what you would have to put up, and that's what you potentially lose. So your return on that amount at risk would be a 26% return. So again, you can see here, you're risking $3.76 to make $1. So that's a negative risk ratio, and that's a bull put credit spread, and that's kind of the typical what you would make, again, depending on how close in to the money or how far out you go, selling your credit spread. All right, so that's your kind of what you'd be looking at, for an example there. Now here's an example of one that we set up on NVIDIA, and this is, I like to use my extreme range bands in these kind of trades, and you can see that NVIDIA had sold off really hard, and this is what we call the 3 ATR. So this is like three standard deviations away from the 20-period moving average here. So it's very extreme. And so once you get past this level here, a lot of times you can get these really kind of like a rubber band snapback. So then we had the cycle reversal here. So again, like the covered call, I like the credit spread when you sell up here. This is selling out of the money, when you get really oversold. So this is selling out of the money when you get really overbought. So I like to do those spreads, in those kind of situations. So here was one that we had set up on NVIDIA based on that kind of market condition. So it was extremely oversold, so went out and sold the bull put credit spread, and it was traded at 99.66. So sold the short 84.80 bull put credit spread here The short strike was an 84 strike, and at that point it was a -20 delta. All right, so they're giving you your 80% probability kind of theoretical trade. All right, so short the 84 put, long the 80, so brought in 95 bucks credit brought in, and then it was trading down here going into the expiration at 124.87. So the spread was then at a penny, cover that back, 30% return. So that's a pretty decent little return, you know, on that trade. So I like to be very selective on these, but again, if you go into, think about this, if you go into a trade with a, you know, 80% probability, and then if you have indicators that increase that probability even more, then you get even a higher probability of a winning trade, right? So if you've got an indicator that, you know, is wins 70, 80% of the time, that's also going to increase that probability. So those are things to combine in your trading. Now, the third one is what we call the iron condor credit spread. So this is basically the combination of these two strategies together. So it's a combination of the bull put credit spread with the bear call credit spread. So if you think a stock or security is going to trade in a tight range sideways and just kind of stagnate, you know, that's the perfect scenario for the iron credit spread, iron condor credit spread. So very good for premium collectors because you're getting both sides, you know, of that additional premium, but you're also going to protect your losses from the debit spread side of the trade. So this is, again, it's going to take advantage of that time decay and volatility crush of your options into expiration. So if you've got a situation where the market is just contained between, you know, major resistance and major support level, it's an ideal strategy to use. So you're basically, you know, let's say you've got, you know, you're going to be short a bear call credit spread, and then you're going to be short a bull put credit spread. So the combination of those two together is what we call the iron condor. All right, so it's called the long iron condor. You're short the body, long the wings. Okay, so you're basically bringing in, you know, two credits. You're bringing the credit from here. It could be, you know, 50 bucks or whatever. It could be a credit of 50 bucks here. So total could be $100, and your spread width, you know, minus that. So it gives you a larger return on your trade. And you can these are great because you can leg in or leg out. So here's one that we had done on Tesla. So again, Tesla was like trading here, and it was looking, you know, like it was going to have this breakout. So what we did was we did the iron condor credit spread. We initially legged into it, sold the bull put credit spread first. Okay, so it was looking like it was going to push up. So the first thing we did on this one right out of the chute in the morning was we sold, it was traded at 243.30. We sold the bull put credit spread, the 237.5, 235. At that point in time in the morning, it was like a 20 delta, okay? So sold that first, okay? So that was traded at 254, that was trading at, sorry, 243. So sold the 237.5, 235, $2.5 wide spread, brought in $60 credit. All right, so then you can see that this on the 18th, this actual part of the trade was up $46 per spread. All right, so it dropped down to 14, cover it back. That's your $46 there, 24% return. But the other part of the trade was when it started moving back up and then it stalled out. Then we added, during the same day, we added the credit spread side on the bear call credit spread. So now leg two, this was legging it, now it's trading up to 253, same day, sold the 267.5, 270 bear call credit spread with the 23 delta short call there. All right, so that going in had a theoretical, you know, probability about a 77% on that short strike at 267.5. So now we have the 267.5 short, long the 270 here to protect in case it kept ripping up. That was 38 bucks, not a lot of premium, but we combined the two together, and now we have the iron condor credit spread right here with those two combined together, and we had a total credit here of $98 per spread. So total credit received of 98. All right, so we had that started out with the bull put credit spread, brought in, that was at a 20 delta, you know, brought in that 60 bucks there. And then when it pushed up that same day, sold the 267 at 270, and brought in that premium there. So total combination of credit of $98. Now, if it goes out between the short strikes of the spread, this would make 98 bucks. That would be a 64% return on your margin risk, which was $152. Okay, so that's the difference between the $2.50 less your $98 received is your, your margin risk and your return. All right, so here's this one went out right square in the middle, so that was the perfect setup. So we had the bear call credit spread here, the bull put credit spread here, received that full premium of the 60 bucks on the put side, 38 bucks here, $98. So kept that, closed it out actually, 3 bucks there, 4 bucks. So ended up with $91 per spread, 60% return. All right, so these are also always going to be a positive theta trade. So that's what's taking advantage of, that churn in the market. So this is a great way to leg in, leg out, and a way to make some income, on a certain situation where the market is just kind of stuck in a sideways kind of, price range. Now, the next one, which is a really great strategy, is another one that we do quite a bit of, is the butterfly. Now, this spread is constructed for very low but high, reward type trade setup. So basically what it's doing, it's not just two credit spreads, it's going to be combining a vertical debit spread with a credit spread. So by doing this, you're getting the big benefit of the debit spread, which is going to make a positive risk ratio. So you're going to be making more, but you're offsetting a lot of the capital at risk, and you're offsetting the negative data with the credit spread. So it's a really great strategy. And so what it does, it's going to have 3 striking points to the trade. So that's going to be, what makes the butterfly. So basically in this type of setup, you're going to be short time and volatility, and the trade is going to result in a net debit. So the debit cost is your total at risk. So here's your, typical, what a butterfly would look like. So this, for example, could be your long a call here, short a call, and then your short a call, long a call. So you can see your body is where your 2 short strikes are, and you're long the wings. So it's a long call butterfly in this example. And in this example, the total risk ended up being just $100. Okay, because you had your debit spread cost here, credit spread cost here. I think this was like $300, and this was $200 credit. So you combine the two together, you total amount of risk then is the $100, $10 wide spread, $1,000. So you can potentially make, if we go out at the top of the tent, $900, which would be a 900% return, and that's a positive risk ratio. So that's another, good strategy or a great one for certain market conditions. So these are, different ones that, really you should have, with your trading portfolio. Now, the next two are two that I really want to kind of get into, and this is what we're going to get into really in more greater detail next Saturday. So these are 2 really great strategies that I really highly recommend for anybody's trading account or even your investing account, because you can do long-term trades with these as well. So this is the income calendar. So it's kind of what I call the flexibility trade. Now, what this is, the basics of the income calendar is basically kind of a delta neutral trade strategy that's a timing, like a horizontal trade. So you're playing theta decay basically. So it's an income calendar spread. It's kind of a neutral option strategy that's going to profit when your underlying stock just goes stagnant and trades within a tight range. So the way you're going to make money on this is the profit comes from the difference in the rate of premium decay and the implied volatility crush between your short-term, near-term option that you're going to be short, which will have a faster theta decay, right? Versus the long-term option that you're long. So you're going to be long further out and short closer in. So this is what makes this premium kind of decay collection type strategy. Okay, so this is the calendar. Now, when we create the diagonal to it, that really creates a really unique strategy, and we'll go into that one next. But this is the kind of the basic, fundamental kind of one that you need to understand first, and then we can adjust that to the calendar diagonal, which has a kind of a spread component to it. But this is the basis of both trades, how they work. So it's an excellent strategy when you expect a stock or security that's going to stay stagnant in a tight range, that's going to produce you income from the time decay. And so I like to do these with kind of targeted range bound trades. So, lately, when the markets were looking to move lower, we were looking for, targets to the downside, and we would place calendars, to the downside target. So you can do these. The thing I like about the calendar, we can set these up for very low capital at risk. So if we're wrong, we're going to be risking very little, money to do the trade. And then if we get it right, it starts to break down lower. Then we can adjust it to, a diagonal, or we can make it into, different debit spreads or butterflies, things like that. So a lot of different kind of flexibility to it. So it really becomes then a great strategy for market conditions when you want to keep your longer term position intact, say on a stock or an ETF, if you're expecting it to potentially then break out either, up or down in the future, but in the near term is kind of turning sideways. So if we're looking for a downside move, we're going to do a put calendar. If we're going to do an upside move, we're going to do a call calendar. And it's a great way to kind of hang with a trade over time, waiting for that direction to break out that you think is going to happen. And then what you're doing is you're actually paying and getting discounted options because you're getting that time decay. Kind of think of that covered call. So it allows you to get your position, get paid for while you wait for the longer term position to kick in and break out either up or down. All right, so here's just kind of the time graph series to kind of illustrate how this works. So, we can use weekly options, or we can use monthlies, whatever. So let's say you go out and you buy, XYZ, and you're looking for a calendar, call calendar. So you have a target maybe up to $100. You think it's going to, go to $100. This is kind of the way I like to do it. And let's say it's trading at the current point when you put it on, it's trading at 95. But everything looks good, and you think it's going to go to $100. So what you can do is you can go 60 days out, and you buy the $100 call. Okay, so that might cost you $200 or something like that. But then what you're going to do is you're going to do the same strike, but you're going to short it the 30 days closer, so 30 days to expiration, so closer in, right? You short the 100 strike. All right, so what's happening? All right, so the short duration option is going to decay faster in time, right? That time decay really starts to accelerate. So let's say you brought in here, let's say you brought in $100 credit for that, all right? So now you see your cost of your trade would be then $100. Now, what's happening here is that this decays, it's going down, it's decaying really quick. Let's say maybe now it goes down to just 50. And so you buy it back at 50, you kept $50, and then you can see what happened to your trade. Now your trade went from 100 to 150. All right, so you're making that spread. So that's how it works. And then if we want, if it goes up to the 100, what I love to do is then if it looks like it's going to break higher, we'll keep long the 100 strike price, and then we can adjust this to what we call a call calendar diagonal, so we could then maybe sell the 150 strike against it, widen that spread. So it's a great strategy for starting out really low risk and then adjusting for bigger moves, either up or down. So if we're looking for a call move to the upside, we use calls. Moves to the downside, we use puts. So just a really great flexible strategy to do in those kind of situations. So for example, here, let's say you had a 38 July long, okay, and then you shorted the June 38 call against it. So you're opening it for a debit, and the benefits from time passing, time decay, and for volatility crush as you go into expiration. So it's a defined risk, debit pay strategy. That's your max at risk, okay? Takes advantage of accelerated time decay from the options, the different time frames, decaying at different rates. So the option contract, with the 5 weeks remaining will decay faster than the one with the longer, 7 weeks. So the June is going to decay at a much faster rate than the July would, right? So that's what you're taking advantage of, that time decay component, and volatility also, which it ends up going to zero at expiration. So you can see then how this works out. If you look at the 38, let's say you paid 400 bucks, you sold that June 38, you brought in 100, so your debit cost then is 300. That is your total at risk. The stock trades sideways, so towards that June expiration, that 38 June call is going to be lower in value than the 38 July call, right? So let's say, for example, then you're still, holding right about that $400 price range there, but the 38 June call now is dropped down to $50, okay? So you can see it, the value then has gone to 350. So you went from 300 to 350, there's your profits, kind of like a credit spread. So you can see that your return on your capital at risk was 50 bucks on that initial cost of 300, so about a 17% return. So that's kind of the pure, how that works. And then if we want to adjust and we think it's going to break over that July 38 call, we can just, instead of we're still on the 38 call, we may end up selling the 39 or 40 against it, make it a call debit spread, or we can make it a call Condor or call Butterfly, just a lot of different things we can do with it, but we can start it out kind of with that structure. And these, another great benefit is if we have what we call a positive theta or positive horizontal skew, where we get that additional implied volatility pop from the higher volatility. So for example, this is what we call positive theta or positive horizontal skew. So you can see here, the 28th February, 1 day to expiration has a theta here at the money at 73 strike of $34. And the series right behind it has a theta of 16. So you can see that's your positive theta, right? So positive theta and positive horizontal skew. So here's your implied volatility, 92.92 on that front end, and then behind it's 87.58. So these are two other things that you can take advantage of. And I'll teach all this in the course, how to take advantage of these kind of what we call a timing edge and the volatility edge. All right, so that's a look there. Now, when we look at the potential profit from the income counter, the spread reaches this max profit when the underlying closes at the strike price of the short dated option. All right, so that's where you get your max profit from that. And again, just kind of go over since inception what we've had, starting out with these calendar diagonals, starting back in June 2019, actually, is when we started. That 331 trades closed out, 238 winners, 20 break-evens, 73 losers, running around 76% win rate. Again, unaudited for these are just kind of win-loss results there for these trades. Now the next one, this is the one that's really the one I like a lot, and we do a lot of these in this right conditions. It's what we call the calendar diagonal. So it's a combination of the calendar, but what it does, it adds the additional component, the spread component, or the diagonal. So it's a really great medium to long term. You can go out to do these 2 to 3 years out using leaps if you wanted to. And so it's a really great directional option strategy for speculating on trend, and also great for hedging. So basically what it is, it's a vertical diagonal debit spread where you have that long option leg. Again, further out, that's going to be longer, further out time, so it's going to have less theta decay. So that'll be set further out in time versus your short option leg, which is closer in, which gets the accelerated theta decay on that. That's what we take advantage of, like a covered call, to put money in our pocket, and over time we can amortize down the long dated option. So just like a covered call, if you're keeping that money put in your pocket from the call you sell against your shares, over time you're amortizing down the share price that you started with. But this one's even better because you're going long the options versus long shares, so it's a fraction of the cost. So you're going to be able to amortize down a lot faster. So this takes advantage of that short-term weakness or strength, again, that you think is going to eventually in time revert and then either break back to the upside if call-based or to the downside if put-based. So again, think of it, if you've got a trade where you say you're hard down on the market and it's starting to churn, but you think it's going to eventually break out, but you're not sure of the time, then we can set up these call counter diagonals, and it would just kind of churn sideways. we can just keep selling that short dated against it, cover it when it expires, sell another one against it, cover it when it expires. Then if it breaks, that's where we get the options working for us that were long, that we now have bought and owned at a discount, right? So it's a beautiful strategy for that. Or if you've got a market that you think is going to eventually turn to the downside, we can do it with a put counter diagonal. So really great strategy to use in certain situations. So it takes advantage of that accelerated time decay characteristics of that front short dated option that again decays at a much faster rate than the back long dated option. Plus, if you're going to get the benefit if you have any positive implied volatility skew between the two option series. That's an additional advantage. You get more premium you're bringing in from selling that front duration trade. And then there's the big benefit is your vertical spread component, that diagonal part. That's where you really make the money on this trade. So again, buying options at a discount, and the trade is also always, these are going to be done for a net debit cost versus a credit cost. So just a really great overall strategy, for your trading portfolio. So this, along with some of the other ones you like, this is a must-have type strategy. So the other way I kind of like to explain it is think about it as a vertical, say, debit spread. So if you did a call debit spread, that would be in the same option series, right? Let's say that would be in this next week's series of the 23 May or something. So that would be the 23 May would be the debit spread. So you'd be long a call, short a call in the same option series. But with the calendar, you're going to be long further out. So you could be long a July monthly, say the $100 strike, right? And then you could be short against it, the 23 May closer in, maybe $150 strike. So if you look at this, it kind of looks like a vertical debit spread, but here you're getting the benefit of this accelerated data decay from that this duration time frame is much shorter, right? So then you're long that July 100, that July, maybe 30 days, 60 days, whatever out. And this one, let's say that goes to zero, then you just sell the next series. Maybe that's the 1 July, and just keep doing it, rinse and repeat. So just a really great strategy. So these are, of all the different trades, these are probably the most that we've done. So here's just a good example to kind of show you how they can work. So this was one that we had done on XLE, and this was called counter diagonal. So this was set up, it was like on the 31st of December, it's traded 85.70. And this one was pretty cool because we adjusted this and actually made this into a free trade. So I'll show you how that was done. So it went from 85.70 when we were out of this thing, it was trading at 88.17, and we had adjusted this into a free called Condor. So I'll just kind of go through the steps here and then show you. So when it was finished and done with, this was trading at 90.50. So the first trade, you can see how tight this was. It was traded at 85.70. So we had a kind of cycle low. So we ended up starting the trade out where we were long the 17 Jan and then short the 3 Jan against it. So this, you can see the 17 Jan is further out, short the 3 Jan. So the 86, 87.5 and a half wide spread. Now we ended up adjusting this a couple of different times. So I'll kind of go through this pretty quick, but ended up with an adjustment. We were now long the 17 Jan 86, okay, call, and short the 88.5. So we went from the 86, 87.5, and then now we were at the long the 86, 88.5. Okay, so let me just kind of go through this here. And then on the 10th, we did another adjustment. We adjusted this into a free Condor. So let me just go to the next page and you're going to be able to see it. But this was alert trade. These are, some of the alerts that were sent out, the adjustments and things like that. But here's what the trade chart was looking like. So we got into the trade, it was trading right here. Then we had a nice move up. We did a couple adjustments in here that did another adjustment. This is where we adjusted it to the free trade and then took profit here. So we started out the initial trade, it was trading at 85.70, and then we adjusted it to the, ultimately to the long call Condor on the 10th of January into a free trade, and then on the 14th took it off. All right, so here's kind of the stepping you through what we were doing. So initially right here was trading 85.70. We had the 86, 87.5, and then we widened the spread out. So originally we were 86, 87.5, and then we went from 86, 88.5. We widened the spread. So after we did that, we were now long the spread at $1.01. Okay. So now at that point, now the trade had blown out. The debit was at 186, $1.86. We had adjusted price of 101. So at this point in time, on the 3rd of January, it was $85 per spread profit, 84% return. Now now we're working this trade up. Remember, we're into this for a little bit longer term trade. So then we did another adjustment, and now it was trading at 86.70. And that adjusted trade now had gone from 101, and now on the 6th of January, this trade was now at 227. All right, so it was traded at 88.50 on the 6th, and so now the trade spread had blown to 227, less $1.01. So now it's up to $126 a spread, or 124% return. And then we adjusted it to the long call Condor. So this is, what I'll be teaching you in the course. But here it was on the 3rd. Okay, it was trading at 87.56. So the spread was at $1.86, up 85. Then here it was on the 6th. Now it was trading at 88.50. The spread going to 227, and then we adjusted it to the long call Condor into a free trade. So these are the things that you can do. And so we ended up with the trade here. We rolled up the short strike. We rolled up the whole spread. So we ended up with the 87 Jan long, short the 90, short the 91.94. So here we ended up long this trade here, long the 87, short the 90, short the 91, and then long the 94. So in the course, I'll show you and teach you how to do these types of adjustments, okay? So that was adjusted on the 10th of January to that free trade. So we had this actually a credit of $3. So then if it went up, we were gonna make 3. If it went down, we make 3. If it goes out in between here, we had our max potential profit on the trade. So this ended up, we made $192. It was going out right there, so pretty close. So it ended up taking this off a little bit earlier though. So 17th Jan, and took it off on the 14th. It was trading right there. You can see right there. So it went from 3-cent credit to $89 spread, $192 on zero risk. So that's just the flexibility that you get when you can, do these calendar diagonals. You go from the calendar to the counter diagonal to a call Condor or a debit spread or a butterfly. So a lot of different, things and flexibility that you can do. So, today, again, I just wanted to get you better kind of educated and kind of understand the different great trading and investing advantages you get from the different option strategies. So I wanted to give you that overview of how you can, use the different ones to generate income, reduce your trading risk and play general trends, getting paid while you wait. And then this next Saturday, though, I'm going to get into greater detail on these two favorites. So this will be, again, starting next Saturday, the 24th, and we're going to go focus on just the income calendar with the big focus on the calendar diagonal. So, you're going to get the 4+ hour course here with the 6 enrollment bonuses here. So it's $197, but if you use the payment link and promo code today, CAL15, you're going to get this for $167. And so the course will start next Saturday, then we'll finish up on Tuesday. Monday's a holiday, and we'll do a Q&A the next day. So let me give you that link again. And any questions you have on any of the things that we've covered, any of these packages or any trades that you want to look at, just let me know. And then here, use this CAL15 promo code, put that in there, and click on that, and it'll pull up that drop down right here. Come down, select whichever course package you want. Click the buy button there. Put in Cal 15. If you want the alerts added to it, click that. That'll be 507. And put Cal 15. So just kind of a review of what you're going to get with this course. And so course package 1, you're going to get everything here today for 167. So you'll get my cycle reversal indicator. So we're going to be using this in the course to time reversals for these types of trades. You're going to get my extreme range band indicator we'll use in the course. These are the course, these are on my website, the prices. And then you'll get my Fibonacci price target mapping course, which is super important for, mapping out our targets up or down. That's what we use. So this is a 3+ hour course you're going to get as a bonus. You get a 30-day trial membership. You can start this whenever you want, and then hopefully it'll continue on. And we've got other packages. Then we'll do a follow-up Q&A. This will be on Wednesday, and then you're going to get my option trading tutorial, another option guide with videos and stuff. So everything a total of $2,700, and today your price is $167. So 94%, price discount on everything here today. And so that's course package 1. Now, if you do want course package 2, which would be all 5 of my alerts that I send out, these are very selected. Depends on the market condition as to which alert type trade I'd send out. Last week we had one we did on Palantir. We did another one on Walmart. We had a couple of different ones, but so it depends on what the market's given us, and that's what I send out. But this would be course package 2. So with this package, you get everything in course package 1, but you get my 5 different alerts for the next 4 months, and the 4 months my trading club, which gives you my, you get access to my trading room, virtual trading room on my alerts, and you get. We do Q&As every week. I'll go through the additional stuff you get there in just a second. So that's everything you'll get, but everything in course package 1, and this will be, if you want today, 507, plus there's a 2-pay on this. And if you use PayPal, there are a number of different payment options there that are even better. So here, if you look at and break it down, you're going to get everything today at 507. So basically $4.20 per day if you amortize it over that. And if you look at breaking down just the alerts, you take that out of the equation there, you're paying for the alerts for $3.33 a day over that 4-month period. So I think it's a pretty good deal. So we send out, 8 to 12 stocks or ETFs, per month. And it could be either butterfly or long condor. Last week was a long condor on Palantir was one that we did that turned out pretty good. Or it could be a counter diagonal if we see a good setup for that. Or it could be a monthly penning trade. It could be a butterfly or a counter. And we did a monthly penning trade on last week on Alibaba, risking 32 bucks. It didn't pin out, didn't work, but we lost or debit paid at 32. But we'll do selective trades like that. Or it could be a breakout reversal, which typically these are credit spreads. Or it could be an earnings trade. Last week we did an earnings trade on Walmart, a double calendar, which was a small profit. But anyway, so a lot of different type of variations that we do. So we do that, and can you use butterfly to protect a zero-dated option? Yeah, you could. Absolutely, yeah, you could. So with this course, then when I send it out, I'll give you a trading guide for each trade. Now, a lot of the members, they just want my alerts. They'll do their own thing. So if I send out, like on Palantir, we did a long trade on Palantir. They may just go out and buy the shares and just buy the options. But I will always give a option selective strategy for the trade I send out. So I'll give you that trading guide for every alert, trade setup video review that day after the close. The trades are listed in archives, so you can go back and look at them. Now, you'll also then have the access to my weekly Q&As, which are live and recorded every week for the next four months. And now with the alert service, you can start and stop too. So if you want to start this, after the course or later, you can. And if you go on vacation or have to take off for work, you can stop your time and then come back. So you're not going to lose anything. And then you're going to get my daily video newsletters. So that's every day after the close. I'll send that out. What I'm looking at as far as the market, the trades that we're doing, review those. and then access my virtual trading room, which is open every day during the week. And so from 9:30 to 10:30 Eastern, 5 days a week. And so you'll have that the next 4 months. And then you're going to get also anything on my website, any of my courses or any of my other trading software, you'll get, using your member discount code, you'll get 60% discount on everything that I have on my site. So those are all the kind of benefits there. So if you go, let's say I'll just show you real quick. If you were to go to the site, how that works, just go to Paracycle Trading, and then you'll have your members code of 60% off. And if you go into any of my trading software, you want to buy my scanner or anything here, you'll get 60% discount off the price that is on the website, or any of my courses. If you go to my trading courses here, any of my any of my courses, you'll get a 60% discount. All right, on the price there. So if you were to do this option course here, the price is, $597. If you put in your, promo code here, your members code right there, you're going to get this 60% off. So that's basically how that would work. And so you'll have that for the next 4 months. So yeah, again, the alert service, we've had great winning success with this. Started the first one back in 2018 through yesterday. 872 trades closed out, 629 winners, 59 break even, 184 losers, 79. So this is a combination of all the different 5 different alert services. And then the other ones will be, the butterfly calendar. I'll show you some more of those trade examples. So again, today, use this code that I just gave you, and you'll get everything in package 1, 167, or package 2, 507, and a 2 pay. And yeah, here, Johnny, use that link there, click on it or copy it, and then make sure to use Cal 15, and then you'll get that discount. All right, so that's kind of a summary there of everything. Make sure there are no other questions here. What is your opinion of using a will strategy, since it seems to be buzzed? I just stick with what I use. The will strategy is, kind of, one that some use, but it's okay. I prefer, what I'm showing you here. So that's, I don't know if that helps you much or not. It's not something I really actually use. All right, so that's, what you're going to get. So again, you can check out, if you've already got the course here, it'll show you on your members account tab right there. So just check that out. And the bonuses, these are just part of the course, okay? So these are going to be used in the course. So again, if you already have these, just, for those that do not have these tools, these are needed for the course. So these are just going to be tools that are added, as bonuses. So that's where we, get this bonus package here. But again, the main thing is the course and everything. So you're going to get everything today for 167, which is the live course, and then everything in the course is recorded, broken down in modules. And you'll get the full PowerPoint of the course, all the, the recordings and the follow-up Q&As and handouts and all that stuff. Here's some nice feedback from one of my members, Pam. She said, just saying a quick note of thanks that you could maybe pass along to Larry for all the fabulous teaching through the years. I've truly enjoyed learning from him and the other traders in the trading room every day. I don't think there's a better trader in the world when it comes to option spreads and other ways to trade than Larry. Thank you so much for that, Pam. Now, the course, we're going to break it down in kind of part 1. We're going to start out with the kind of the Greeks that you really need to understand for these 2 types of strategies, okay? And really how time value works, and probability analysis, how to use your standard deviation for price forecasting, how that option pricing works, and then we're going to go through the trading rules and timing rules that we use for these 2 strategies. And then we'll get into part 2, the basic of the income strategy. So this will be the calendar. So this is kind of the foundation that we'll cover first, which will then lead into us using the calendar diagonal. So it's the basic of how this actually works, and the benefits of it, how that is, the characteristics, how you get that trading edge. Kind of the first one I call the time and theta edge, risk review, trade setups. We'll go through that. And then we'll get into the one that I really like so much is the calendar diagonal. So you really need to understand first the calendar, and then that leads you into using this one right here, okay? So then we get into the basics of this calendar diagonal, the benefits that we get from it. This has really two main key characteristics. First is what I call the trading timing edge part, and then we get the second edge is your directional, that the directional component of this trade, which is the diagonal, the spread component. It gives you a fantastic way to trade these medium to even, like I said, long term. We can go out using leap options 2 to 3 years out. So if you like a stock rather than buying the stock, we can go out using leaps, buy those for a fraction of the cost, sell calls against it, do stuff like that. So just a really dynamic strategy. So then we'll go to trade setups, in the course, and then how to do adjustments, defending adjustments, and how to adjust these things to different potential, free trades. So then you get a resource library, trading library. So it's a really, of all the courses I teach, it's a really important one to understand and use this strategy in your trading. All right, so just one last kind of overview. Here are the enrollment bonuses you're going to get. You're going to get, first off, my cycle reversal indicator. So this is based on what we call percent R. And so what this does, this indicator just shows you reversals, and it shows you, it's what we're going to use for cycle reversals up and down. And it's a great indicator to use for setting up these, calendar diagonals or put calendar diagonals, okay? So we're going to use this in the course. It's got an upper and lower study. So the upper study will show you the reversals with the arrows. The actual lower study actually shows you the actual signal, show you how that works. So these are available for Thinkorswim, TradeStation, TradingView. You can have one or all three. So you're going to get this indicator, and we're going to be using this in the course. So it's a tool that you're going to need. And then the other tool that you're going to need in the course is my extreme range band. This is a great indicator showing you when we get to kind of extremes of the market, when the price is getting too extended from the mean, which is the key moving average we're going to use. I'll show you how this works in the course. So it becomes an alert signal for buying or selling exhaustion. So this becomes the first signal that a security is starting to reverse. So very accurate in signaling in advance potential swing trades or longer term trend reversals. So this is available for Thinkorswim, TradeStation, eSignal, Ninja. So you'll get that. We'll be using this in the course as a tool. And then here's the extreme range bands. These are based on our average true range. And the reversal, you can see here, just in this example here, we had this big move up here. This was on QQQ. We had the reversal here, had the reversal here, starts pulling back, had it here. And we're getting in this kind of situation currently right now. So this is one that we were actually, I'll show you, we were actually looking to set up a put calendar diagonal on Friday, but decided to wait until Monday. But you can see that we're getting into very stretched conditions. Here's the extreme range band. You can see here what this indicator looks like. This is what you're going to get. You're going to get this tool. See how this 3 ATR right here, we're getting stretched out here. All right, so now you can see here's our cycle reversal. We're very close to getting a reversal signal here. So we'll probably get this next week, and we'll probably be looking to do something off of this, maybe a put calendar diagonal, things like that. So you're going to get that tool along with this, below you're going to get the cycle reversal indicator. So that's an example of the tool that you'll get there as part of the bonus package for this course. So everybody will get that. No, and I can't give you these for wealth charts because wealth charts is that's a kind of a joint venture deal, so I can't give you these for as a bonus. But apologies for that, but that's just the way that my deal works out with them. But again, you can, you're going to have this for, you can see the indicators. I've got the reversal indicator for Thinkorswim, TradeStation, TradingView, and the extreme range bands the same. okay? But wealth chart's just a different animal. And then you're getting my price target mapping course. This is a very important part of the course as well, because this is how we set our price targets up or down for, that we're targeting for targets for, profit targets to the upside or defense targets to the downside. So this is a really important course that I like to give out a lot of times because it's what we use, for mapping out our course, what I call target mapping. So it's based on Fibonacci levels, based on moving averages, based on support resistance, standard deviation, forecasting, and option activity, okay? So it's a 3+ hour recorded course with 139-page manual, just a fantastic course. And so, we'll be using this kind of stuff in the course next Saturday. And then you're gonna get a 30-day trial membership if you do package 1 to my trading club. So you'll get 30 days. You can start this whenever you want. If you want to wait till after the course, you can do that. And so this will give you access to my virtual trading room every day during the week, 9:30 to 10:30 Eastern, Monday through Friday. Do a daily video newsletter as part of the the trading club. We do these video are archived. We do a weekly Q&A, live and recorded. We have a trader's educational vault with some good educational material there, and then also you'll get the 60% discounts off of any course or trading software on my site for over the next 30 days. You'll get your members discount code. And this is one thing I always like to point out. This is Jay, one of my old members, said reading books is fine, but seeing the actual option trade set up makes a huge difference. So that's a big plus. If you come in the trading room, you can see all the things we're doing. If you have a problem on a trade or you want some help, then come in and ask a question. I'll be there to help you in the trade room. And then you're going to get, as a bonus 5, we'll do a follow-up Q&A. So this will be for the course. This will be on Wednesday. Okay, so we're going to have the course next Saturday, and then we'll finish up the course on Tuesday since Monday's a holiday, and then we'll have the Q&A the next day. So you'll have fresh on your mind if you have any questions. And so this will be then you also have the virtual trading for the next 30 days. So a lot of support there. And then one last thing. So just to really giving you a lot of option, educational stuff in this package, you're going to get my option tutorial. So this is a 60-page option guide with videos. This is basically covers the Greeks, how option pricing works, standard deviation, option delta. So this is just another option, 60-page option course with videos. So just a lot of concentration on options in this, course next week in the package that you're going to get. And then just here's another, one review of the elite service. So this was Waleed. Waleed's one of my members in Kuwait. He said, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trade alerts. Some are good. Hold on, I'm looking here. Yeah, thank you so much, Shamish. Appreciate that. Here's just from one of my members. Let me plug that in. Appreciate that very much. If I can copy and paste this thing, I'm going to put it up here. 1 second. One second. Yeah, thank you so much. Here, this is, appreciate this. Please advise your audience that by taking you up on your offer, they will be assessing an unequivocal gold standard in quality teaching synergized with astonishing accomplishments. Thank you so much. So that really kind of summarizes it better than I can. Thank you so much. And so, but this was from Waleed, and Waleed was saying it says that I have to mention one thing. I'm subscribed to a lot of services that send out trade alerts. Some are good, others are not that great. But one thing that I would like people to understand in this webinar is that when I get a trade alert from Larry, I do it blindly. It's time to show me that this man is that accurate in his recommendations. And so also from Dan, he says, very diligent, totally thorough with your analysis. That is what the foundation of success is. And so this is a really key part. He said, I paid for my subscription with the first 4 trades I took with you when I was learning just how to trade options, okay? So I try to send the alerts out so you can just understand the trade setup when they're sent out. We use what we call telegrams. So it sends it out super fast, okay? So as soon as I click it, boom, it's there. Okay, so that's from Dan, and yeah, so 1 second here. Give me 1 second here, everybody. So that's, you know, one thing I pride myself with trying to make sure you understand the trade so that if you want to take it, you're going to be learning a lot as you go. And yeah, here's the link again, powercycletrading.com/special, and don't forget to put in Cal 15. Cal 15. All right. All right. So, you know, so today everything's going to be 507. And basically, if you strip out just the alerts from the 197 course package, you're, you know, going to be paying a little over $3 a day for the alerts that you get. And so use that, you know, small cap Cal 15. I think I'll put that in, but make sure to use that. And then you'll get that 15% off. All right. So then, you know, send out various alerts. This past week, I'll show you one that we just did, but either be butterflies. We do a lot. Lately, we've been doing a lot of long condors because the market volatility has been so extreme, but now the market's settling down. So that's why I wanted to, you know, go over and teach this course on counter diagonals. We're starting to get back in a kind of a little bit more stable market environment. But when we're in the really high volatility, we were shortening our risk with these condor type trades. So that's kind of what we've been using for the past 3 to 4 weeks or over a month, I guess, you know, even longer. But over the course of the X number of years, we've been doing more counter diagonals because they're just got longer term setup. So really important strategy to understand. Okay. So you'll either get that, or we may do a butterfly for penny trade, or, you know, like I said, a credit spread or certain specific earnings trade. So cover whatever the market's given us with these 5 different types of alerts that are sent out. And again, you'll get a trading guide, trade setup video review, trades are listed and archived, access to the weekly Q&A for the next 4 months, video newsletter for the next 4 months, access to the virtual trading room next 4 months, every day during the week, and 6% discounts on everything on the website. So a lot that you're going to get a benefit from there. And again, just kind of reinforce now when I send out an alert, you know, a lot of people just want to do their own thing. So again, like for example, last week we did PLTR, so long trade. So a lot of members just, you know, bought calls or call debit spread, but we did in this trade, I sent out the trade entry level and I gave you the specific option strategy to use, which we actually use the long call Condor. So with the entry levels, when I send out the alert, I'll give you profit targets based on this unusual option activity. You know, Fibonacci levels, so you use that price target mapping, what option series to use, stop loss level guidelines. I'm constantly updating these trades and you know, and keeping you updated throughout the day if there's anything you need to know. So you know, I'm your eyes for the trade, you know, throughout the day, so you don't really have to do anything. So then at the end of the day, if we, you know, put on a new trade, I'll do a video news setup video trade on that to show you why I did the trade, what I was thinking at the time. Then I'll also go through my video newsletter after the close to show you, you know, what, you know, I'm looking at as far as the market, potential trade setups we're looking at for maybe the next day or so, or that week. And then we do the weekly Q&A, so we have access to this for the next 4 months, access to virtual trading room, open every day during the week, 9:30 to 10:30 Eastern, and those discounts of 60% off. So here's you know, the calendar diagonals. One last review of that. We've had 331 closed out, 238 winners, 20 break even, 73 losers, 60 or 76% win rate, unaudited. And here's just a couple, examples. Here's one that we did. This was on CCJ, and this one was, set up on the 21st. It was trading 53. Did the adjustment on the 12th, and then it was trading at 57, and then had a profit take on the 24th. So I'll just kind of run through this one here, but you can see we set it up right here, did an adjustment here, took the trade off right there. So here's what that looked like going in. So the original trade, we had this set up, we did the 53, 55, 1 second here. Sorry about that. So anyway, we started this trade out. We had was trading at 53, so we set up the 53, 55. You can see calendar diagonal. So we were long that 7th Feb right here. You can see that further out in time, and then sold against the 24 Jan. We had set it up at $1.95. So this trade then was, on the 22nd. Now this trade was trading at right here. It was trading at 57.45. We did the adjustment, so the spread went from, now is at 253 and originally at 195, so we're up 58. But then we had the next step to the trade. We had the trade where we had done adjustment. We widened out the spread. You can see here we had the 53.55. So what we did was we rolled the spread up. This is what we'll be covering in the course. So in order to lock in some profit, so we rolled the spread up from 53.55. You can see we rolled the spread up and widened it out to 54.58. And then we had adjusted, we had reduced our price to $1.86, and we had a wider spread. See, that went from a spread width here of $2 and $1.95. We locked in some big profit from rolling it up, and I'll show you in the course how to do it. Now we're long the 54.58, $4 wide at $1.86, and now the spread profit was on the 24th went from $1.86, now it was at $4.83, so we're up $297 per spread, 159% return. So that's what these are such great trades, because, and again, right here, see, this is the key. This kind of trade is what I love to use when we have a trade where we're getting kind of like here, you see we're getting kind of this bottoming action. So then we can set the trade up, and we can stay in the trade longer if we need, waiting for the breakout. And again, we can go out, you can go out 1 month, you can go out 2 or 3 years with this type of trade adjustment or this kind of trade setup. So really important one to understand and use in your investing or your trading. So that's just an example of CCJ. And I showed you this one at XLE, a little earlier. So just kind of run through there. And then here's some butterfly and long condors. Here's one that we just set up. We've been, like I said, doing a lot of these lately because of the market, but we've had 226 closed out, 163 winners, 16 break even, 47 loser, about a 79% win rate, unaudited. Now, these are going to be of all the different potential spreads. These can give you huge returns when you're doing butterflies. And the risk on these trades are very, very low based on the trade structure. And that's why lately we've been doing a lot of these. So here's one that we just did last week. This was on Palantir. We set this up on the 13th. It was trading at 123. And then we did an adjustment on it, ripped, when we put it on the 13th, this thing ripped straight up. So we adjusted this trade further up to the upside. I'll show you here in a second. So then we took that profit. It was going out pretty much max profit on Friday. But when we originally set the trade up on the 13th, it was trading at 123, and then it ripped straight up. And in the same day, it was going at 129. So we adjusted the whole trade up. So ended up then with the trade where we now are long the 125, 127, and then short against the 136, 138. You can see we started out the trade long the 123, 125, but we rolled and adjusted the trade up and did really good with that adjustment. And so at the end of the day on Friday, now it was trading up here at the end of the day, max profit of 128 per spread, up 177%. So with these types of trades, we're gonna, send out adjustments and alerts to, start scaling out, take some profit, hold some, et cetera. And so then on Friday, it went out right there. So we got in on this right there on the 13th, had a big, huge rip up that day, adjusted the trade up, and you then see it went sideways. So this was a perfect setup because we had it contained right here. So then it ripped up here and then went sideways the rest of the week and ended up going out between our two spreads for max profit. So here's what that looked like. So we had adjusted long the 125, 127 called debit spread, and then sold above it the 136, 138, and adjusted price cost of $72 per spread, $2 wide spread, 200 bucks, lesser cost. Potential profit 128 or 177% return. You can see right there, and this one actually ended up with the max profit on the at expiration on yesterday. So here's where it went out yesterday. So it's up $128 on that risk of 72. And so that was just one that we recently set up there. Here's another one just to show you. This was on SPY put Condor. So this was one that we did on the 10th of March. So it's trading at 568, and we were looking for a move down. And so this one set up really well. I'll just kind of run through here real quick on this trade. So when we set this up, it says new SPY reset short. So it's trading at 568. So went out and bought the vertical 11 March 563, 560. And then what we did when it ripped down, we sold a bull put credit spread against it that same day, or the next day, excuse me, adjusting this into a long put Condor. And we reduced the trade to a very low risk. So we had this adjusted to this put Condor for, let's see, 11 March 550, 547. And then we had the other side of the trade. So we had so we were long the 563, 560 put, and then we sold against it the 11 March 550, 547. So let me show you that one. This one really turned out great as well. So here's just ripped down. We sold the additional bull put credit spread, adjusted this into the put Condor. And so you can see this was a combination of the 563 put short the 560. And then we legged into it by selling the 550, 547 bull put credit spread, reduce our risk down to 43 bucks. Potential profit, $3 wide spread, lesser cost of the trade, 43, 257 bucks, potential for a 597% return. And this one pretty much nailed it as well. So like I said earlier, look to hit singles and doubles, then we're going to hit some home runs. And this one was one of the home runs that we hit. So this ended up going out right there. So the spread, you can see, went from that adjusted 43 up to $3. So went up 257 bucks, $597, or 597% return on that. So that was another really nice setup there. And then here are just a couple of examples of these, what we call, these are lotto pinning trades. Now we did one last Thursday on BABA, which didn't turn out, but we lost it was basically, risking 30, ended up 32 bucks to, potentially it would have made close to 200 on 32, but these are really fun. And these are just what we call these lotto pinning trades. So here's one that we did on NVIDIA. And you can see here it says new NVIDIA long binary monthly option penny trade. NVIDIA was trading around 115. So trade set up for a monthly pin. I'll just kind of flip through it. So then we went down here and so it said to buy this butterfly, the 118, 122, 126 at 30 bucks. Okay, so I said hold the bid at 30. So we got into this trade, I believe, around 30 bucks. And then you can see here it was on the 12th. And then on the 20th, now this trade went from, now it's trading at 115 when we entered. Now it's at 118.81. And here it was going out at the end of the day at 119.66. So this was up $131 or 503% return. All right, so this was a butterfly pin trade here. We set it up right there. And here it was. Almost perfect, not quite, but close enough. And so this trade was set up right here for the max risk. We sent out for 30, ended up into it at 26 bucks. Okay, so we had the 118, 122, 122, 126. This is per spread. So if you did one, it was 26 bucks risk. If you did 10, it's 260. Potential to make spread width of $4 less your cost there. Potential to make 374, that'd be over 1,400% return. All right, so there was the potential for a huge home run on that one. And then it went out right here on this trade is where we were getting out 130. So still not bad from 26 to that spread blew to 157. So up to $131 per spread. That's a 503% return, which is not to be taken lightly. And then here was a really good one on SPY that we had set up, and this was a put butterfly. This turned out to be really good. So it was traded at 573.80, and so you can see here it says new SPY penny trade, trading around 573.80. Binary put butterfly. Okay, so that means we're gonna the debit paid is what our risk is. So I said we're gonna do the 10 March. 565, 60, 55 at around $40 or lower. Debit paid will be your risk. And then you can see on the 10th, now it's trading here. When we set this up, 573, now it's trading at 567. It said that look to take profit today on any move lower towards 560. And then you can see here it's trading at 561. If long the put butterfly, now look to take and close today up around 232 or $595 or percent return on that towards the end of the day there. So this was turned out to be a really nice put butterfly here. So I got into it there, getting out right there. So here was this one had a potential to make right here. You can see this was targeting 560. So did the 565, 60, 55. So $5 wide spread, $39 a risk. Potential, if you get the perfect pin for 61, that would be over 1,100% return. So that was on SPY. And then I get my drawing tool to pull over here. And then it went out right there. So this thing was up to a spread profit of 417 right at the end of the day. And again, we scaled out, but here's right at the end of the day, this thing perfectly pinned. So it went from $39 debit to $456. So this was up $417 per one spread, okay, per spread on that risk of 39. That's over 1,000% return on that penny trade. Okay, so you can see these things can really make the difference in the account. And this was probably one of the best ones I've seen. This was incredible. I always like to point this one out. This was on Tesla. And so Tesla's been a really good one. We've had a number of really good ones with this, but it was trading at 189.35 when we set this up. And we were looking for this one to pin at 200, which it did. So sent out this trade. This was a Tesla long binary butterfly pin trade. It was trading at 189.35. Potential monthly expiration pin trade. Okay, so we did this 197.5, 200, 202.5. Now did this for $12. Okay, so this is what made it so incredible. And then on the 16th, Now it was, when we set it up, it was at 190.89.35. Now it's trading at $200 on expiration. So here it goes out at expiration 200. It's up $230 per spread, over 1,900% return because of this cost of the trade was so low, 12 bucks. Set it up here, got out the last part there. And so this was for a debit cost of 12 cents or $12. Spread width, $2.50. $12 cost, potential make 238, 1,983% return. And that's exactly what it got right at the end of the day. Boom, right at the top of the 10. So this is about as perfect as you can get it. So it went from 12 bucks to 250. So at the end of the day, this thing was up over 1,900%. All right, so those are the things that you'll get with the alert service if you want to add that to it. And that's pretty much everything. Any last questions, feel free to fire away. And here's the link one more time. Just use that powercycletrading.com/special and Cal 15. All right.